Hey, Dan Passarelli here. How are you feeling today? I hope you're feeling great because today we have part two of maximizing profits, single legged options versus debit spreads. And it's going to be great. I want to make sure you can hear me. So please hit that Q&A box and let me know that you can hear me. I would sure appreciate that. Jan. Great, great, great. Excellent. At least one person can hear me. There's Tomas. I knew it was coming. Cheng, what's up? Everybody's here. Okay. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. I see some usual suspects. I do. But I see some new friends here. And I love that. So if you don't know who I am, you're about to. I'm going to tell you right now. My name is Dan Passarelli, and I am an author of two of the most popular option trading books. And I have my third one that is just about to hit the shelves. I'll tell you about that in a second. And I do a lot of videos. I send out a pretty comprehensive Sunday video with my thoughts on the market going into next week. And I have a Substack, which I know many of you are members of. And I am also a trader. I traded on the floor of the Chicago Board Options Exchange. I traded on the floor of the Chicago Board of Trade, which became part of the CME group. And now I trade in a regular old retail trading account, just like you. So I can share a breadth of experiences that can be very beneficial to your success, which is why I'm here today, which is why you're here today, which is why we're all here today. And I've been doing this stuff for a long time. I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries. And we've put tens of thousands of students through our programs. I am also, well, even before we get to that, I'm a podcaster. I know many of you listen to my podcast, Wealth Building with Options. But I collaborate with people in the trading industry. In particular, I collaborate with the best options brokers in the world, like Firstrade here. I also collaborate with most of the options exchanges globally and trading organizations. Man, I've been around the block. And when I say the block, I mean the world. Geez Louise, it's been quite a career. I'm also a family man. Those of you who are market taker students proper know my wife, Kathleen, who runs operations here at Market Taker Mentoring. I have my two adult children and my two small, cute little dogs. And I do other things for fun. I'm a runner, a foodie, a traveler. I do a lot of traveling. I've got little trip coming up. Gonna see some parts of the Mediterranean, from Barcelona to Sicily to Greece. That's coming up. This might be your last time hearing me for a while, but guess what? I have got my compatriot, John Kamisic, who's going to be teaching you, which will be great. He's going to take over while I'm gone. You're going to love John. Ex-Goldman guy. Did I say that? And I mentioned that I've got another book coming out, and I want you to be among the first to have the opportunity to get it in your hands. So if you go to bcwwo.com, or just take out your phone and aim it towards that little QR code there with the camera app open, you can go and put in your first name and your email, and you are going to be on the list to hear about when the book officially launches, which is actually right around the corner, April 28th. And for people who join early, like right now, we're going to give you some bonuses, updates on the book, and a whole bunch more freebies. So it is definitely worth it to go to bcwwo.com and get on the list, or just aim your camera app at the QR code right there and get on the list that way. I'm very, very, very excited to share this book with you. Okay, let's talk about creating advantages with options. There are several advantages of option trading. First of all, leverage. Second of all, limited risk. These are actually related things, kind of two sides of the same coin. And we want to benefit from both as much as possible. And if we're going to do that, we've got to optimize our strategies as such. Now, the simplest optimization is just, hey, I'm bullish on the stock. Do I buy the stock or do I buy options? But once we determine options, or as we're considering whether options should be the choice, we've got many choices in the world of options as well. Like, for example, spreads. What do I mean by spreads? Well, we have two different choices here. We have outright options, which are just buying a call or buying a put, or we have spreads where I'm buying one call, selling one call, buying one put, selling one put. Each have advantages for optimizing risk and leverage. How do we know which one to use? Should we always choose spreads? No. Sometimes outrights, just long calls or long puts, are better than spreads. But sometimes spreads are better than outrights. How do we know which one? Well, it depends on the market scenario. This is why we have all these choices. Because in one set of circumstances, you make this choice. In another set of circumstances, you make this other choice. As far as single leg options go, we have limited risk. We can only lose what we pay for an option, and unlimited profit potential. Now, that is strictly true when it comes to long calls. It's basically true when it comes to long puts. I mean, technically, if the stock goes to zero, you stop profiting. But if you buy puts and the stock goes to zero, you're going to be really, really happy, and it's going to feel like you made unlimited profit. So single legs are the best choice when we're expecting a big move. And this is what we talked about last week. By big move, like why are they better when we're expecting a big move? Because if there's a big move in our direction, like we buy calls and the stock goes up, then we make a big leveraged profit. If there's a big move and we're wrong and it goes against us, then we have limited loss. With debit spreads, we have less risk than single legs. And we might actually have more profit potential. Isn't that crazy? Like a lot of people don't really realize that. They don't think that that you can actually make more being long a spread, but there are some times when you actually can. So let's take a look. Debit spreads are the best choice when expecting limited stock gains. If I think a stock is going to go up, but not a big volatile move, I can literally make more money with a spread than I can with a single leg, both percentage wise and in absolute terms. And so, as opposed to breakouts and strong momentum trades like we talked about last week with single legs, here we're talking about a trend that's expected to be limited by support for puts or resistance for calls. And if you're not familiar with what we're talking about with single legs, please do a favor for not me, for you, and go back on Firstrade's YouTube channel and look at the archived recording of part 1 of this, because I went into great detail on it. But we're looking for like breakouts where the stock crosses support or resistance, or we're looking for event trading, or maybe even like momentum, like strong trends, moving average crossovers. Those are great for just going in and buying a call or a put. They're great for that kind of a thing. Other setup criteria might include, there's a stock rallying and there's just no resistance in sight. It's one of these high flyers that keeps making new highs every other day, up, and there's no resistance that can restrict price movement. Or maybe, the stock made a new high like 3 years ago, and it's just looking like it's just aiming that way, but resistance is still far away. If I'm expecting a fast move, that's better for single legs because of theta. We can overcome that by selling shorter term options. We can really overcome it when it comes to spreads. And the one thing about single leg options outrights is that we really got to pay attention to implied volatility, which is kind of ironic in a way. You know why I say it's ironic? Because usually people who only trade single leg options are the novice option traders. They learn the basic thing and they want to get it down, and they do get it down, right? But haven't moved on yet to the more powerful tools in the toolbox. And so they're trading the most basic options thing, but they're probably trading it too basic. They're now looking at implied volatility, which really makes up a bigger proportion of your trade when it comes to outrights than it does with spreads. And we talked about volatility last week. This is just a really quick review. Realized volatility, which is also called historical volatility, is just how much the stock has moved around. Technically, if we want to put numbers on it, it's the annualized standard deviation of an asset price. And then implied volatility is the trickier of the two. Implied volatility is how cheap or expensive options are. It's the volatility figure that, when entered into a pricing model, yields a theoretical value reflecting current market prices. And basically, what people say is that it's the market's estimation of the future volatility of an asset, but it's not really actually true. People think it is, but it's not. The volatility implied by option prices, I mean, it technically is, but it's always wrong. Low implied volatility is beneficial for buying single-legged options, like I said, but what if I want to make a trade in this particular class of stock options, but implied volatility is not low? What do I do? Well, I have to consider a different strategy. So, the best strategy for the setup, we always want to optimize our theta, vega, and strike proximity. And when I say vega, I'm talking implied volatility. So we match the strategy we choose to the particular specifications in the forecast. And we do that by choosing the specific expiration or expirations, or the specific strike or strikes. So we talked about outrights last week. And so again, if you missed it, where you been? You should have been here last week. Go to Firstrade's YouTube channel and check out number 1. But as long as you're here, you might as well do that afterwards. Because right now we are going to talk about debit spreads. With debit spreads, we have less exposure to time decay and volatility than we do with outrights. Let me say that again, because that is way super important. With debit spreads, we have less exposure to time decay and volatility than with outrights. So remember, I was saying we got to worry about theta. We got to worry about implied volatility. We got to worry about those things much less when we're trading debit spreads. So that, in some ways, makes them potentially better. We're not able to put those things on our side as much, but if volatility is not low, then a debit spread's way better. Or if time decay is big, the debit spread's way better. And here's really the magic. And I'm going to tell you something. I didn't actually realize this until I started teaching options. Yeah. So like my career path, I was a professional trader, right? I was a professional trader. And then I started teaching options and I realized, oh my gosh, if you look at the Greeks of buying a call versus the Greeks of buying that same call but selling a different call, a higher strike call, a debit spread, your delta gets a little smaller. But your theta and vega get massively smaller. Typically, your delta will be, about maybe 35 to 40% smaller with the debit spread. But your theta and vega can be 90 to 98% smaller. So it's kind of ironic, but in some ways, it makes it more of a pure directional trade. That's not a universally true statement either, because the timing matters. Debit spreads are if you want to be good at debit spreads, they're a lot more complicated than people think. You have to put in a little more thought than maybe at first you think you do. And when you do, you're going to have lower risk when used in the right scenario and possibly greater returns when used in the right scenario. That said, the trade-off to this, because who wouldn't want lower capital outlay and maybe greater returns? Everybody wants that. So what do you give up? It sounds like it's too good to be true, isn't it? Well, I don't know if it's too good to be true, but you do give something up. You give up upside gains. You can only make so much. So let's take a look at an example here. There's a chart of Palantir. Let's say a trader is looking at this chart and expecting a recovery for whatever reason. Maybe they're looking at RSI and believe that they're oversold or something like that. Okay. There's resistance at 145. And so maybe we're thinking, I think we're going to get a bounce here, but I'm not going to count on it going much above 145 right now. Could happen, but I'm not going to really, I think resistance could hold it down. Well, a trader thinks the stock will rise from its current value of 145 by March expiration, okay, which is about 5 weeks away, we'll say. Put this together a couple of weeks ago. John helped me, actually. John, who is going to be your host on the next presentation from Market Taker, he put it together. So rest assured, he knows what he's talking about. So which option would we pick? Which option would we even pick? Well, in order to do that, we're going to need some more information than just looking at this option screen. We're going to have to get our Greeks and implied volatility involved in the conversation, right? So again, the stock was at, what did I say? The stock was at 135, I think, right? And that it could go up to 145, but I'm not really going to count on it going up much more than that. So which option am I choosing to buy? Which option am I choosing to sell? Now, there's a lot of ways to set up debit spreads. And I'm going to tell you something. Like I said, you want to be good at this. You should, this is the part where you should be taking notes. The easiest strike to select is the short strike. The 145 strike in this case is an easy one to select. Why is it the easy one to select? Because whenever I buy a debit spread, I have a maximum profit. And I'm just going to skip ahead to this slide here. Whatever I pay for the spread is the most I can lose. But if I'm above the short strike, in this case, the 145 strike, I stop profiting. That's the red line. The green line is just buying the 130 calls. I continue profiting if I only buy the calls. But if I sell the spread, I don't profit if the stock's above 145. So what's the trade-off here? I have less risk, but my profit is capped. So to go back to our example here, I have less risk, but our profit is capped. Well, if I think that the stock is probably not going to go up above 145. Then I don't care if I continue to make money if the stock rises above 145. Do I? No, I don't care at all. Right? I mean, sure, if it goes up to 155 or 160 or 180, I'm going to be like, oh, crap, man. I probably could have made more if I just bought the call. But I mean, you know, I also could have made more if I mortgaged my house and put all my money into it. But I would never do that because, I'm trying to make good trading decisions. I'm not trying to get lucky. And if I think the stock is not going to go above 145, the best decision I can make is a debit spread, selling the 145 strike calls and allowing my profits to be limited to the stock going up to 145, but not above. So that one's a no-brainer, man. Always set your debit spread strikes to the point where you think the stock will not go through. Always set the debit spread's short strike to the point where you think the stock will not go through. What about the long strike? Now, here's where it gets tricky. John Kamisic is a big fan of buying in the money calls. Why do you think that might be? Because I could buy, I know I'm definitely selling the 145 calls. That one's like done for me. I could buy the 140 calls. I could buy the 135 calls. I could buy the 130 calls. I could buy the 125 calls, 120 calls. I could buy any of these. John likes to go a little bit in the money. Why? Because of the Greeks. Because he gets a bigger delta going in the money. And theta and vega are smaller for in the monies than they are for at the monies. So, what do we get with any option trade? We get three different things that we're trading that we're either going to make money or lose money on. Direction of the stock moving, time decay, or volatility changing. Or I should say, and volatility changing. I like to describe any one single option or option spread as you're trading a basket of those three things. And just like you might choose different ETFs, hey, do I want the healthcare ETF or do I want to buy the technology ETF? I mean, they're both ETFs, but the components of the basket are made up of different stocks. Well, it's the same thing when it comes to an outright call versus a bull call spread, a call debit spread. They're both a basket of direction, time decay, and volatility, but the mixture is a little bit different. Direction between the two strike prices is a lot more direct with a spread. Delta to infinity is a lot more direct with an outright call. Time decay, going to be a lot smaller with the spread. Volatility risk or vega, going to be a lot smaller with the spread. So let's look at the specific Greeks of the spread, and you're going to see what I was talking about here. You're going to love this. So if I buy 10 of the March 130 calls at $9.85, I'm getting long 57 deltas. I'm losing 14.7 cents a day, and I'm making and I have a vega exposure of 15.4 cents. If I sell the March 145 calls, is that right? Hold on a second. Oh, yeah, I guess it is. If I also then sell the March 145 calls, I'm getting short 31 deltas. I'm actually making 11.8 cents a day, and I'm getting short 13.8 cents in Vega. So if I'm comparing this spread with just buying the March 130 calls, I mean, first of all, just look at where it says net right here. I'm investing like 35% less. That means I can lose less. I can only lose 605. Otherwise, if I was just buying the calls, I could lose 985. But here's where it gets super interesting. The delta of the spread, the 130, 145 call spread, is 45% of the 130 calls. 26 cents is 45% of 57 cents. So I lose just a little over half of my directional exposure. But my theta goes from 14 cents to 2.9 cents. My theta is 20% smaller. It's 20% of the size. 2.9 cents is 20% of 14.7 cents. I lose 80% of my theta drip. Vega, I lose 90% of my volatility exposure. So my delta is actually so much more concentrated. So much more concentrated. So maybe instead of buying 2 calls, I buy 3 spreads. And let's see, if I bought 2 outright calls, my delta would be 114. If I buy 3 outright spreads, my delta would be 78. Pretty comparable. And I'd be paying about the same amount. 2 of these would be just shy of 10, but it would be $9.70 or $19.70. 3 of these would be $18.15. So it's pretty powerful, the difference that I can get here. Which one would I choose and why? Well, let's see how it plays out in a few different scenarios. The stock rises $15 today and volatility is unchanged. Okay, so if it does that, I would make a $3.90 profit, or 64%. Now, you would think from looking at that profit and loss diagram that if the stock were to go over 145, that I would that I would reach my maximum profit. But this is one of the things I was talking about. This is this nuance that is really kind of tricky. I don't really reach my maximum profits until close to expiration. And this is where, you know, we can kind of get like a head explosion sort of thing here. Oh man, I can hear the ice falling off my roof. Isn't that crazy? Who lives in the coldest area? What's the temperature by you right now? Here, I'm going to look at it. What is the temperature by you right now? I want to see who lives in the coldest area, because I am so sick of this weather here in Frankfort, Illinois, which is 20 degrees. 20 degrees. And who lives in the warmest spot? Jan, 8 degrees. Where do you live, man? Where do you live? 8 degrees? Jason, it's 7 degrees Celsius. Celsius. I used to pick on the, metric system and Celsius, but you guys are actually right. Americans, like, why do we still use this imperial system? But because we still use it, I just can't get used to it. I just can't get used to the metric system. But 7 degrees Celsius, let's see. It's got to be, well, 0 is 32 Fahrenheit. And what, like 20 degrees Celsius is like 60 degrees Fahrenheit? So that's not too bad. It's better than 20 Fahrenheit, I think, right, Jason? Um, let's see. Gregory, please move to Southern Florida. I know, man. I know. You guys got it good, unless it's the summer. Unless it's the summer. Oh, yeah, and you're in Czech Republic, huh? Okay. It's fit Larry, for goodness. Larry's rubbing it in. Rubbing it in. 56 degrees. It's cold in Florida. Oh God, Larry. Well, how come you didn't invite me to stay with you for like the whole winter? I'm a good house guest. I like to cook. I make you some of my Sunday gravy. Uh, I didn't ask. All right. Next winter, what do you say? Somewhere like maybe between November and March. What do you think? You got room? Gregory, it's 75 at your place. Holy moly. Oh gosh. You suffer from this. Oh, yeah. Uh, Celsius Fahrenheit calculation also. Yeah, I know. But I mean, most of the world, you can talk to most people in the world. Um, you know, Americans can only talk to Americans. In fact, is there anybody from the UK here? Don't people in the UK also now use the metric system? They're the ones who stuck us with the imperial system. 8 in Europe, in the Czech Republic, in Prague. Oh my gosh. Oh my gosh. Oh my God. Oh, 8 degrees is 46.4 Fahrenheit. Okay. Hey, thank you. So, yeah, well, you still got it better than us, Jason. Oh, okay. I was waiting for somebody. Ching in Ottawa, Canada, minus 11 degrees. That doesn't matter if it's Celsius or Fahrenheit. Uh, it's cold. Whenever there's a minus before anything, it's cold. Cold, I tell you. All right. So back to business here. Yeah. I know. I don't know. I'm not, you know what? In a week, I'm going to be traveling around the Mediterranean. So I'm going to be okay too. I just got to make it one more week before I get a couple of weeks off. Probably should have planned it earlier, but what are you going to do? All right. So anyway, here's what's interesting about this. Actually, there's a lot of really interesting things about this. So if the stock rises $15 today and volatility is unchanged, then I have no effect of theta. I have no effect of vega. And my effect of delta is all delta. Now that's a $15 move because my delta was only, 26. But hey, I mean, it's 64%, but I mean, that's a really big move in one day, right? I mean, that's like, that's a big move. That's almost like, it's like 9% or something. No, it's like 11% or something. So I don't know, I can't really count on something like that happen. It's just, that's an unrealistic example. What's something more realistic is, Over 21 days, the stock rises 15 bucks. And because the stock rose over a long period of time, implied volatility likely falls in these scenarios. That's not universally true with all stocks, but it is with most. So we get a little bit of a different picture here, but it's a little bit kind of interesting. It's a little bit kind of interesting. So, all right, 15 bucks. We basically get probably the same effect of delta. I say probably because, here's where we've got to start getting a little more technical. My gamma changes, and so my delta changes at a different rate, but I'm just trying to make it easy here, So still have about the same effect of delta, but over 15 days, losing 2.9 cents a day of theta, I lose 61 cents in theta. In Vega, if implied volatility falls 6 points and each one of those points loses me 1.6 cents of option premium, I lose another 10 cents in Vega. So my profit might theoretically be smaller. But this is still kind of an oversimplification, because what happens in actuality is my delta probably does stay about the same. It might actually get a little bit smaller because of the effects of gamma. But my theta starts to become a little bit different, as does my Vega. With my theta, once the stock gets close to the short strike, which in this case is the 145 strike, my theta actually changes. It goes from negative to positive. I forget if I have some of that in the presentation, but hold that thought. That's pretty important stuff. So then as time passes, because I'll have a positive theta, I start to profit just from the stock not moving. So let's compare these to the debit call spread versus the March 30 calls. If the stock rises 15 bucks over, say, 14 days, 2 weeks, and implied volatility falls 6 points, which one do we do better on? Well, let's see. We would have made $3.39 on the debit spread and $5.57 on the outright call. Why? Well, because we didn't really lose too much from theta or Vega on the debit spread. Our delta helped us out more, but not enough to make as big of a difference. So because it was a big move, it was okay with the outright. It was better actually with the outright. But if we go a longer period of time, that starts to change. Why? Because of theta. Because we lose so much more theta every day, and we're adding another 7 days. If we go out to 28 days now, look at this, 28 days, we'd actually probably, to tell you the truth, the debit spread probably would do better. It's just very hard doing it without like a pricing calculator or something. Because when we get to the point where theta is positive, Because remember, whichever strike you're closest to in a spread has the dominant Greeks. Now, delta, it's always positive for calls and negative for puts. But all the other ones are a lot more nuanced. And they all kind of function the same. Delta is sort of the unique one. At the money has the highest gamma, theta, and vega. So that means when the spread started out, so down to the yellow box on the left, our theta was negative. Why? Because we were closest to the 130 strike. The stock was at 135. So closest to the 130 strike, which was the long strike. So we're losing money on that spread because we're losing more on the 130 calls than we were making on the 145 calls. But then once the stock rises and is at like 150 or whatever, the theta actually becomes positive. And then we start making money on it. So, I mean, realistically, it's pretty hard to do this as a static example to tell you the truth. But realistically, the debit spread probably would have made more than the 130 call being spread out over this long period of time because of how theta changes. So let's do this comparison again. Looking at it at the short strike, 145, the short strike specifically of the debit spread, because the outright long call has no short strike. That's really sort of the pivot point where the debit spread stops being as valuable. Technically, it's a little bit farther. Technically, it's like up here. But anywhere below 145, the debit spread always outperforms. Even if the trade is a loser, it loses less if the stock is under 145. Only if the stock rises way too much is the long call better. And, here's the thing. There are definitely some stocks that are those high flyers, like right now we've got stocks like MU, LITE, these stocks that just like have parabolic gains. But that's not the common stocks. That's not the I should say normal stocks, because common stock means specific thing. That's not the normal stocks. Most stocks have smaller moves. And just think about it like, I'm sure at some point I've done a presentation here with Firstrade where I talked about log normal distribution, right? That means it's like kind of like a bell curve, but shaped a little bit differently. Log normal distribution means that on all stocks across the board, on average, most moves are small moves. But every now and then there's a big move down or a big move up. And because returns are compounded and the stock can go to infinity and there's an interest rate component, the log normal distribution has a fatter tail to the upside, or a longer tail to the upside, I should say. So with the stock at 145 at expiration, that's where the rubber really hits the road when it comes to debit spreads. There is a strong timing component, because here, look, I gotta do like a little drawing on here. This is an at expiration profit and loss diagram. I'm going to go, oh, here, wait, let me change the color to dark green to match this. Hey, what's going on here? Okay. So in reality, before expiration, the debit spread profit and loss diagram looks more like this. It's smoother. Oops. So before expiration, you don't make the maximum profit. And if it's a long time before expiration, it's an even smoother line. It's more like, I mean, it's almost like a straight line. It's something like that. This is like a long time before expiration. If I get to 145, I don't make a lot. This is closer to expiration, but still before expiration. I make more, but not my maximum profit. This is at expiration. And, I could do the same thing. I get rid of this stuff. I could do the same thing for the long call, but that's just a little different. For the long call, it's more like, oops. Oh. For the long call, it's more like that. So the long call actually does better in the short run than the debit spread. All right. We need the mouse. Why do I still have this pencil? Gosh darn it. It's annoying. Anyway, sorry about that. So with the stock at 145, the call makes 515 or 52%. But again, at expiration, which is where spreads really shine, it makes 895 or 148%, 148%. And so there's a very key timing component when it comes to debit spreads. It's not just about the direction, it's also about the timing. Hopefully that makes sense. Okay, so if the stock is instead here up at 160 at expiration, well, that's a different story. That's where the call makes $20.15 or $205, but the spread only makes $8.95 or 148%. So do you see, aren't there like a lot of nuances that come into play here? Isn't it? It's a lot of nuances that come into play here. There's how the Greeks change between the two spreads. There's how time affects it. There's the magnitude of the move. Strategy selection is very, very important because profit or loss is affected by how much the underlying moves, how much time passes, implied volatility changes, everything that I just mentioned. So we always want to match the strategy to the expectations. You do that every time, you'll be making better trades just because you're taking into account all the things you need to. And as far as strategy uses go, let's just hit this one more time since we're coming up to the end of section 2 out of 2. Single leg options, great for short time horizon. bigger anticipated moves in the underlying. Debit spreads, when the expected move coincides with expiration, and we plan the short strike with the price target. And it's a great way to spread off the implied volatility risk, which is basically your theta and your vega. All right. All that good? All right, friends. Did everybody, I don't know if people came in late, did everybody get a chance to get on the list to be the first person to get a copy of my book as soon as it comes out on April 28th? Just go to bcwwo.com or get your phone out right now and click that QR code. And then all you got to do is put in your first name, best email, and you are on the list to get exclusive pre-launch bonuses, updates on the book launch, and much, much more. Gregory's asking, in a nutshell, when to use debit spread versus credit spread. Okay, so that's a whole nother conversation. But with credit spreads, you tend to want to have more breathing room. Okay. Because with the debit spread, typically, I mean, you have a delta right off the bat, and theta generally hurts you right off the bat because you're closer to the long strike. Whereas with a credit spread where you sell two out of the money, well, you sell an out of the money strike and buy a farther out of the money strike, theta's on your side immediately. And as long as it stays above the strike between now and expiration, you win. So when you think about that log normal distribution, or just put in your mind a bell curve, if you can't picture a log normal distribution curve drawn, your chances of success are going to be so much stronger with a credit spread. And so you might say, well, Dan, why wouldn't we always just do credit spreads if our chances of success are so much better with credit spreads? Well, because there's a trade-off, right? There's the risk reward. With the debit spreads, I was risking like $6 to make $9. With credit spreads, I might be risking $4 to make $1. So, they're a pretty different animal. But Gregory, my friend, we're going to talk about credit spreads in the near future. I forget. I just put together the second quarter of classes that Firstrade and I are doing, and it is going to be great. So that's a good question too. Gregory says, so debit spreads are more conservative. It depends how you consider conservative. Debit spreads have a more conservative risk reward ratio, but credit spreads are more conservative in that you're more likely to produce a winning trade. Your odds of success are better. So, yeah, just keep on the list. Well, not just the list for my book, but also keep on Firstrade's list so that you can attend my webinars, and I'll be doing one about credit spread soon. I promise you. All right, friends, have a great rest of your day. I will, Jan. I will. I know I can't wait to get out of this gosh darn cold weather. I hate it. I'm getting too old for this stuff. All right. See you soon. You'll have a great guest speaker coming up for the next couple of weeks. Talk to you. Bye.